Welcome to Module 2.2. In this session, we're going to familiarize you with the basic terminology used in crypto trading. Understanding these terms is crucial for navigating the markets effectively. Let's begin with cryptocurrency. It's a type of digital or virtual currency that uses cryptography for security. Bitcoin, Ethereum, and Binance Coin are some examples. Cryptocurrencies are decentralized and typically operate on a technology called blockchain. Blockchain is a system of recording information in a way that makes it difficult or impossible to change or cheat the system. It's a digital ledger of transactions that is duplicated and distributed across the entire network of computer systems on the blockchain. In crypto trading, a wallet refers to a digital wallet where you can store, send, and receive cryptocurrencies. There are different types of wallets, including hot wallets, online wallets, and cold wallets, offline storage. An exchange is a platform where you can buy, sell, and trade cryptocurrencies. Binance is an example of a cryptocurrency exchange. Exchanges match buyers with sellers and often offer additional features like charts and analysis tools. Altcoin stands for alternative coin. It refers to any cryptocurrency other than Bitcoin. Examples include Ethereum, Ripple, and Litecoin. Altcoins can vary greatly in their technology, functionality, and applications. Market cap, or market capitalization, is the total value of all coins of a particular cryptocurrency in circulation. It's calculated by multiplying the current price of the coin by its total circulating supply. Volatility refers to how rapidly the price of a cryptocurrency can change. High volatility means the price can move greatly in a short amount of time, either up or down, which can be both a risk and an opportunity for traders. Now, let's talk about liquidity. Liquidity refers to how quickly and easily a cryptocurrency can be bought or sold at a stable price. High liquidity means it's easier to trade a cryptocurrency without affecting its market price significantly. Two key terms in trading are bull market and bear market. A bull market is when prices are rising or are expected to rise. Conversely, a bear market is when prices are falling or are expected to fall. These terms reflect the mood and trends in the market. FOMO stands for fear of missing out. It's the anxiety of missing out on potential profits from a rising market. FUD means fear, uncertainty, and doubt. It's often used to describe negative information or rumors that cause prices to drop. A term born from a typo, HODL, originally meant to say hold. It's now used in the crypto community to describe holding on to a cryptocurrency long-term rather than selling it in response to market fluctuations. ICO stands for Initial Coin Offering. It's similar to an IPO in the stock market. ICOs are a way for cryptocurrency startups to raise funds by issuing a new token in exchange for established cryptocurrencies like Bitcoin or Ethereum. A coin is a cryptocurrency that operates independently on its own blockchain, like Bitcoin. A token operates on an existing blockchain, but is used for specific applications, like smart contracts on the Ethereum network. A smart contract is a self-executing contract where the terms of the agreement between buyer and seller are directly written into lines of code. They run on blockchain networks like Ethereum and can automate processes, transactions, and agreements. Moving on, let's discuss decentralized finance, or DeFi. This term refers to financial services like borrowing, lending, and trading that are built on blockchain technology. DeFi aims to create an open-source, permissionless, and transparent financial service ecosystem accessible to anyone without the need for traditional financial intermediaries. Staking is another important term. In the context of cryptocurrencies, staking means holding funds in a cryptocurrency wallet to support the operations of a blockchain network. In return, stakers are often rewarded with additional cryptocurrency. Mining is the process by which new units of a cryptocurrency are created and transactions are verified and added to the blockchain ledger. It involves using computer power to solve complex mathematical problems that validate transactions. In cryptocurrency, a public key is akin to an account number that you share to receive funds, while a private key is like a PIN or password that you keep secret. It's essential never to share your private key with anyone. The term Satoshi or SAS refers to the smallest unit of Bitcoin, named after its mysterious creator, Satoshi Nakamoto. One Satoshi is 100 millionth of a single Bitcoin, or 0.00000001 BTC. It's helpful when discussing smaller transactions and prices. Gas fees are transaction fees on the Ethereum network, paid to miners for processing and validating transactions. Gas fees can fluctuate based on network demand. Lastly, fiat refers to government-issued currency, such as US dollars or euros, which is not backed by a physical commodity like gold. In crypto trading, you often exchange fiat currency for cryptocurrency and vice versa. With these terms in your trading vocabulary, you're better equipped to understand and engage in the crypto market. Next, we'll delve into understanding market orders and limit orders, essential concepts in executing trades.